Stock market investments are like that. One is they are for the long term. Second, the less you tinker with them, the better. The minimum that you have to invest is 5 years. I always hesitate to talk about this because unfortunately we have a bank deposit mindset. Bank deposit is a 5-year bank deposit. Moment 5 years are over on the 365th day of the 5th year, over. Money is back with you. The equity time horizon is at least 5 years. What is the meaning of at least 5 years? If the money that you're putting into the stock market is money that you cannot afford to block for 5 years, don't get into the stock market. How long should you invest? The answer comes from various persons, including one from India. Whatever controversies about him, this piece of advice that he has given to investors is absolutely correct. He says, be greedy, but be long-term greedy. The danger occurs when you are short-term greedy. You want to get rich quick. As he says, get rich slowly. Everybody can do it. Warren Buffett, always invest for the long term. Our time horizons are forever. He is not even talking about 5 years. Our time horizons are forever, he says. If you are not willing to own a share for 10 years, then don't own it for 10 minutes. So the next time some stockbroker is telling you, buy at 9 a.m., sell at 12 noon, just ask one question. Do you know more than Warren Buffett? There are only two ways he can answer the question, either yes or no. So if he says, yes, I do know more than Warren Buffett, show me your investment track record that is greater than Warren Buffett's. If the answer is no, your next counter will be very simple. Then why are you giving advice that is contrary to the world's greatest investor? That is where you will expose a stockbroker for what he actually is. If you are not prepared to own a share for 10 years, then don't own it for 10 minutes. The stock market is a mechanism by which money is transferred from the impatient to the patient. There are so many investors who actually held on to their portfolios almost through the global financial crisis. 5-6 years passed, nothing much happening in the portfolios. They sold it. I know of so many cases. They missed this whole boom that we have had in the last 1 year. So these are things that you have to guard against as an investor. And understand that the equity time horizon is very, very important. If you ask me, who are my heroes in stock market investment? There are a number of people, including in this very city, who have been investors for 3 or 4 decades. Today, they get dividend incomes of 8, 10, 12 or more lakhs per year. Dividend incomes. Their normal living expenses may be half of that. They are reinvesting dividends even today. The only thing is you are not even aware of who these people are because they live comfortable lifestyles but not flashy lifestyles, and they never talk about their investments because they know that there is nothing to talk at parties, at anywhere else. They will never brag about their investment. If at all somebody is talking, it's the speculators. Because they know that there is nothing much to talk about. It's only buy and hold. We have bought, we have held, we have made money. It's as simple as that. I still remember a case where an elderly gentleman in his 70s expired. An excellent investor. The only problem was he had not briefed his wife about his equity investments. So she had a terrible time getting out. Everything was in the physical form. We helped her get everything in her name. They were huge amounts. We had to even break the news to her slowly about how valuable the investors are. We didn't want to get her to get a heart attack for good reasons. Because a heart attack is a heart attack, whether you get it for bad reasons or a good reason. I didn't want her to collapse in my office because her estimate of what the husband had left her was about 15 to 20 lakhs in stocks and mutual funds put together. Mutual funds was about 10 lakhs. The equity portfolio was 4.5 crores. So I had to break it very gently to her that you see this certificate is worth, this alone is worth 25 lakhs, not your total is not worth 25 lakhs, etc., etc. But I remember a time when all the physical share certificates came in her name. And then we had to demat the same. In that period, she received in the physical form a dividend warrant. She forgot to put the dividend warrant into the bank. That was from ITC. So she came to my office one day worried, see, this is 3 months are over, I forgot. I said, no problem, we have to just return it to the company and they will send you a new warrant. You sit down, I'll dictate the letter. As I was dictating the letter, we write to the company secretary that we are enclosing dividend warrant number so and so, dated so and so, for rupees. I myself had to blink once. That single dividend warrant of ITC was 1,95,000 rupees. These are the people who are my heroes in equity investing. People who invest throughout their lives in a growth avenue, live off the dividends in retirement. Such people are much more than we think they are, but they do not reveal themselves. Let's listen to this beautiful saying by Jason Zweig about long-term investing. He says, if after checking the value of your stock portfolio at 1:24 p.m., you feel compelled to check it all over again at 1:37 p.m., ask yourself these questions. Did I call a real estate agent to check the market price of my house at 1:24 p.m.? Did I call back at 1:37 p.m.? If I had, would the price have changed? If it did, would I have rushed to sell my house? By not checking or even knowing the market price of my house from minute to minute, do I prevent its value from rising over time? That last sentence is worth reading again. By not checking or even knowing the market price of my house from minute to minute, do I prevent its value from rising over time? If you understand this, you have understood the beauty of the buy and hold strategy and why it works, whether in real estate or whether in equity. Jason Zweig, anything by him is worth reading, either a book or an article. He is one of our finest financial writers today in the world. 4 ways of investing in equity. The first way is invest in a portfolio of blue chip stocks, diversified across major segments and sectors of the economy. For this, I am distributing a paper that we first wrote in 1988. It's now about 26 or 27 years old. It's been used by a number of people in various parts of India where I earlier did consultancies, including in Mumbai. This is the latest version, of course. Not many changes. Investing in the stock market is investing in the economy of the country. When you look at the Indian economy, what do you see? You see segments, economic segments and economic sectors. What is a segment? A segment is a very large component of the economy. And in India, as in most other countries, we have 3 main segments. Those 3 main segments are services, manufacturing, agriculture. When I studied 35 years back, we had not heard of services at all in the economics that we used to study. It was agriculture, which accounted for 60 to 70% and manufacturing 40%. Today, services alone is almost 60% of the economy, of the GDP. Manufacturing is hardly about 25%, agriculture is down to about 14 or 15%. There has been a tectonic shift in economic segments. These segments and the productive activities that take place in these segments contribute to economic productivity as measured by the gross domestic product every year, the GDP growth rate, which will now become very important when we go into the union budget. In these 3 segments, there are distinct sectors. Let us take services. Banking and finance is a very important sector in services. Software is once again services. Travel, tourism is also a part of services. Telecommunications is part of services. Manufacturing, automobiles, cement, steel, pharmaceuticals, all come under manufacturing. And then you have got certain elements of agriculture, including fertilizers, would come under agriculture. Now, if you look at the way the stocks are chosen in this portfolio, take the first stock, which is Tata Consultancy. Look at the economic segment. It comes from services. The second stock, Mahindra, from manufacturing. The third, State Bank of India Services. Fourth, Grasim Manufacturing. Fifth, IITC Agriculture. Forget the names of the companies, go to the second column, just see the segment. Services, manufacturing, agriculture. You have picked your first 5 stocks. You have made one round trip of the economy. This is what investing in the economy is all about. We will do only one more round. Number 6, L&T. Predominantly consulting services, delivering large projects. Reliance Manufacturing, Bharti Airtel Services, Sun Pharma Manufacturing, Tata Global Beverages, formerly Tata Tea, Agriculture. 6 to 10, you have made one more round trip of the economy. So in just 10 stocks, you have made 2 round trips of the economy. This is what we mean by implementing what the world's best financial writers are telling us. And without fanfare, this paper has been in existence now since 1988, on 26 or 27 years. Lot of people have used it. The failure rate in this has been 0. In short, 100% of the people who made an honest attempt, I'm not even saying a perfect attempt, an honest attempt to implement this, have never had a bad investment experience. Equity investing can be as simple as this if you do not want to choose the mutual fund route and get into investment directly. Certainly you can opt for this, there is no difficulty. The rest of the first 10 or 12 pages are important. I went directly to page number 13. That tells you how we have formulated the strategy. This is the first way of investing. Second, of course, you can invest in index funds. You can invest in well-diversified equity funds. Use the systematic investment plan route. It's a very good route to invest either in mutual funds or even in equity. We have got equity investment programs. I'm sure Simplus will have them too. Of course, there'll be a minimum. Equity investment is not for everyone. You need a certain level to get into it. At least 20,000 rupees a month is what we keep. Use systematic transfer plans, the debt to equity, what I explained to you in the last session. These are also very good ways of cutting down volatility, dealing with risk. Let me come to a very important thing, taking off where we left John Bogle, dividends. The reinvestment of dividends, especially if you are a direct stock market investor, it is worth understanding the next 5 minutes of this presentation because one of the most important aspects of stock market investment. Seth Klarman is a highly respected value investor in the United States, follows the same school as Benjamin Graham and Warren Buffett. And he has beautifully given us why reinvestment of dividends is important. This may need a little effort to understand, but it is worth making that effort. What does he say? He says, just as financial market participants can be divided into 2 groups, investors and speculators, assets and securities can often be characterized as either investments or speculations. Let's understand what he's saying. When you look at people, they may be investors, they may be speculators. Somebody buying at 9:30 in the morning, hoping to sell at 11:30, speculator. Somebody says, my time horizons are forever. I want to build up a huge dividend income, so I'm going to invest for the next 40 years. Investor. But Seth Klarman is telling us, just like people can be divided into investors and speculators, even assets and things can be divided into investments and speculations. Understand this. The distinctions are not clear to most people. Both investments and speculations can be bought and sold. Both typically fluctuate in price and can thus appear to generate investment return. Since both resemble each other, we can get confused about whether a particular thing is an investment or a speculation. How do you distinguish between the two? He says there is one critical difference. Investments throw off cash flow for the benefit of owners. Speculations do not. Gold, no cash flow. A plot of land, no cash flow. An apartment, if kept locked up, no cash flow. An apartment, if rented out, cash flow. So, if you are not living in the apartment, but you have an apartment as an investment, and you have kept it locked, you do not exploit the cash flow, it is not an investment, it is a speculation. For something to be characterized and defined as an investment, there has to be a cash flow. That is why we do not consider gold as an investment. An equity portfolio generates dividends. Real estate generates rental. Now let us proceed. The return to owners of speculations depends exclusively on the vagaries of the resale market. You only got a price fluctuation, nothing else. Investments, even very long-term investments like newly planted timber properties, will eventually throw off cash flow. One day the timber will be harvested and sold, and cash will be generated. A machine makes widgets that are marketed. A building is occupied by tenants who pay rent, and trees on a timber property are eventually harvested and sold. How beautifully he has given this. A machine can generate cash flow every day. Why? It can manufacture things every day. Every day those things can be sold. Now from a day we'll go to a month. A building is occupied by tenants. Generally rentals are on a monthly basis. And now he's going from a day and a month to sometimes if you take a teak plantation, it can generate cash flows only maybe 50, 60 years down the line. But cash will be generated. That's an investment. By contrast, collectibles throw off no cash flow. The only cash they generate is from their eventual sale. You are not dependent upon cash flow. You are dependent only upon price fluctuations. The future buyer is likewise dependent on his or her own prospects for resale, nothing else. Purchase, sale, price, price. That's all. So just as people can be divided into two, investors and speculators, even assets can be divided into investments and speculations. And the difference is there a cash flow or is there no cash flow? This is one of the most important insights into equity investing, or for that matter, investing in general. And if you want to know how important it is, there's this very renowned firm called Crandall, Pierce and Company that does research in the US. This is not your equity research. This is research into good investment strategies. What works, what does not work, what is important, what is not important. Just follow this one example. A $1 investment in the S&P 500 stocks on 31st May 1946 would have been worth $47.53 on 31st July 2002. $1 becoming $47. Please note the time frame, it's a very long time frame, 52 years. In 52 years, $1 becoming 47 without reinvestment of dividends. Had dividends been reinvested, the $1 would have grown to $405.92 in the same period. We think of dividends as coffee money. Something that comes, it is to be spent. It's nothing. You put 10 lakhs in stocks, you'll get about 15,000 rupees dividend. What is that? Something that appears very insignificant in the short term can be very, very significant in the long term. Because dividends may be 1%, 2% when you get them compared to what you have invested. But they have one characteristic like rentals, which others do not have. They do not remain steady. They grow in the future. Dividends also grow. It's not only your stock prices. Dividends grow. Dividends remain much more stable. We saw a 60% fall in stock prices in the global financial crisis. Do you know what the fall in dividend incomes were in those 2 years for people who received dividends? Hardly 10%. If somebody was getting 10 lakhs, they got 9 lakhs for 1 year. Then it grew again. Not only do dividends grow, they are much more stable than stock prices. Very much more stable than, you hardly feel the difference. And for a 10 lakh dividend income to become a 9 lakh dividend income, there must be a very, very serious drop in the asset price. So, what we think is unimportant very often turns out to be very important. There's this beautiful old English saying, milk from the cows, eggs from the hens, a stock by God for its dividends. Whoever wrote this had the correct idea. Is that a stock for the dividends? The dividends are going to one day amount to something. The dividends help you reinvest. The dividends help you accumulate. Then it becomes a true growth investment. And the last word from Benjamin Graham. Far from being an afterthought, dividends are the greatest force in stock investing. Unfortunately, for too many equity investors, dividends are an afterthought. Is there some way we can harness this power? There is a very simple way. When I advise equity investors, I say you've got your demat account, link your demat account to a SB account. You have to register a savings account. A separate savings account. Separate savings. You're not going to use that account for any purpose other than receiving dividends. Supposing you're investing 20,000 rupees per month in each stock, starting from 1 and going down in that list. The dividends that you receive in the first year will be laughable, maybe 1,000 rupees. Second year it may come to, total may come to 3,000 or 4,000 rupees, no problem. Let 3 or 4 years pass, but when the dividends get to 20,000 rupees, buy the next stock in the list out of turn. You have reinvested dividends. You will find that, yes, it took me 3 years to reinvest my first dividend. It will not take you 3 years to reinvest your second dividend. That will be much quicker. Suddenly a day will come when you are now making more than one reinvestment per year. This happens to a huge number of investors. Huge number of investors. Dividends tend to grow over time. Plus you are investing systematically. So on all your fresh purchases, there are new dividends coming. Let me caution you one thing. You will see no miracles happening in the short run. This is not instant coffee. This is filter coffee. It will take 7, 8, 9 years for you to suddenly see the difference between not reinvesting dividends and reinvesting dividends. Don't think something is going to happen even in 3, 4 years. Most of these people see the good things happening in 7, 8 or 9 years. But get into that discipline. Have a separate SB account. Let all the dividends flow there. Today it's very easy with the demat thing. In the old days it was difficult. Let it amount to something, reinvest. This will make a huge difference. You are not there only for 7, 8 years. If you are there for longer than that, it will make a huge difference. When the time comes for retirement, you can stop reinvesting dividends, you can start spending the dividends. If you need to. There are people who spend dividends and still have got dividend income left over for reinvestment. When you invest in the stock market, always invest with a margin of safety. So many people ask, when a client meets a stockbroker, the conversation is very limited. What is the conversation? How's the market? The market is fine. How are you? That's the question that should be asked. How's the market? Second thing is it a good time to buy? Third, what stocks to buy? Unfortunately, the entire conversation between a client and a stockbroker is this limited. Only 3 questions. There's nothing else. How's the market? When to invest? What to buy? Now, how's the market? I will not comment on. What stocks to buy is already in your hand in the form of the paper. Invest in the economy. We address the last question. Timing the market. Should I time the market? Is there something called a good time to buy, or is there an approach? When should I invest? Index is now 29. Should I invest or should I not? There is a beautiful, simple, scientific method. Once I tell you this, you will learn it as a life lesson. You don't have to ask anybody anything. The margin of safety comes to us from Benjamin Graham. In 1934, Benjamin Graham, together with one of his research assistants called David Dodd, wrote this book called Security Analysis. Please don't buy and read this book unless you have a sleeping problem. 10 pages, you'll be fast asleep. You buy and read the other book, The Intelligent Investor, by the same author, but that is written in a simplified form. But in this book, Benjamin Graham gave us this priceless thing called the margin of safety. I'll be explaining it to you in very brief terms. What Benjamin Graham said was, every stock has a true value. You can calculate this true value. And he had complex mathematical models to calculate the true value. And he gave it the name intrinsic value. Intrinsic value. True value of a stock. And then he said, the market value need not be the true value. In fact, it will almost never be the true value. It will be higher than the true value or lower than the true value. You've got true value, see the market value. If the market price of the stock is below its intrinsic value, buy. If it is above, don't buy. If you need to sell, you can sell, but don't buy. This was Benjamin Graham's approach. Problem is, the accurate calculation of intrinsic value and margin of safety can be quite laborious. End results may not be accurate, and such undertakings may be well beyond the capability of the common investor. You and I cannot do it. So Benjamin Graham himself was asked, can you simplify and as usual give us a thumb rule? And he said, yes. This is it, the middle point. Ensure that you do not pay too high a price for stocks. That's all. Margin of safety means do not pay too high a price for stocks. The same philosophy we use in daily life. Is there a discount sale? We rush to buy. That's all. Ensure that you do not pay too high a price for stocks. How can we do this? 4 steps, 4 simple steps. Step 1, be aware of the price-earning ratio ranges of the stock market. We are so fixated by price. Index is only price. Index is important. It tells you where the market is. It's a good statistical tool. But you are also paying for earnings. Price and earnings are captured by the PE ratio. And the PE ratio of individual stocks has no value whatsoever. But the PE ratio of indices, the NSE 50, the BSE 30, that has some value. That is telling you about the PE ratio of a group of stocks. And in India, you can easily get this information on the websites, in the financial dailies. What is the price earnings ratio of the BSE Sensex or the NSE Nifty? And historically, these price earnings ratios are varied between 10 on the lower side and 30 on the higher side. What is the PE ratio? It is only this much. How much is the stock market prepared to pay for every 1 rupee of earnings of the stocks in either the BSE index or the NSE index? So if you have a P ratio of 20, it means that an investor in the stock market is prepared to pay 20 rupees as a stock price for every 1 rupee earnings of all the companies in the index. Now, these are easily available to you on the websites of the Bombay Stock Exchange and the National Stock Exchange. The second is, you must be aware of the market highs and lows and the percentages of high to low falls. And for this, let me give you a few statistics. The first major fall we had was in April 1992 in the wake of the Harshad Mehta scam. On the 22nd of April 1992, we had an index of 4,467. 26th of April 1993, it crashed to 2,037. Watch the percentage. We had a percentage fall of 54.4%. The NSE Nifty was not there at that time. This was only the BSE Sensex. Then we went to the technology bubble. 3 things happened there actually in those 1.5 years. The 3 things that happened between February 2000 and September 2001. One is the technology bubble, software bubble burst. You then had the Ketan Parekh scam, and 6 months or 7 months later you had the terrorist attacks, 9/11 terrorist attacks. Very bad period of 1.5 years. 11th February 2000, you had an index of 5934, crashed all the way down to 2,600. About 1.5 years later, Percentage fall 56.18%. See how close this is to the previous. And during this time, of course, you had the Nifty also. These were the figures for the Nifty. More diversified, so slightly lower fall, 51. This alone tells you a very important thing, how important diversification is. And then we have the recent global financial crisis, which is supposed to be the second worst ever global financial crisis. 8th of January, we had this figure of 20,873, crashed all the way down to 8160 points on 9th of March 2009, 60.91%, almost 61% for the BSE Sensex, little lower for the Nifty. If you want to know what happened in the US, the Dow Jones Industrial Average, roughly equal to, that's also 30 stocks, roughly equal to the Sensex, 14,165 on this date. That was the high, this was the low, this is the percentage fall. What does this teach us? Historically, falls in the market have not exceeded the 50% mark by much, except during the Great Depression of 1929-1932. If you want the figures at that time, 3rd September 1929 was the high, 381 points. 8th July 1932, three and a half years later, this was the kind of fall you had. That was when we had the gold standard. From then we shifted to Keynesian economics, which are followed today. A lot of fiscal measures, monetary measures are used, and there's a sort of shock absorber in the whole economy. So hopefully we will never see something like this again. Even at this time, the investors who did not panic, did not lose money, and the people who had the courage to buy at these levels, they then became USA's billionaires in the next 2-3 decades. What is the thumb rule for determining the margin of safety? There are two simple thumb rules. The price earnings ratios of the popular indices must be 18 or less. And the popular indices must be at least 25% below the last peak. Ensure that you do not pay too high a price for stocks. Benjamin Graham does not say purchase at the bottom. Nobody can do it. You can't sell at the top, you can't purchase at the bottom. You probably will do the opposite. But these two thumb rules, if 50% is the largest fall, half of that, 25%. If between 10 and 30 is the normal P ratio index, yes, 20 is the midpoint, but the weighted average midpoint generally is about 18. So most investment advisors ask you to ensure that it's 18. These are the only two things you have to calculate. Can we do a calculation for today? Of course we can. Yesterday's date, today there is no market. P ratio of the Sensex is 19.91. The Nifty is 23.62. Present Sensex versus last peak. The last peak was 29,682. It has closed yesterday at 29,231, just 1.52% below peak. Nifty, just 1.32% below peak. The answer is staring you in the face. Is there a margin of safety? Clearly no. Whichever way you look at it, no. So the next question is, what should I do? Should I not invest anything in the stock market? Understand one thing. Of course, the margin of safety comes to us from Benjamin Graham. There is one exception to the margin of safety. What is that? An investor who has a long-term systematic investment plan in equity or an equity mutual fund need not follow the margin of safety, provided the investment is continued uninterrupted for at least 5 years. If you are into systematic investment, the margin of safety does not apply. You can start systematic investment when the index is 15,000. You can start it when it's 50,000. It doesn't matter. The margin of safety is only for lump sum investments. I have 10 lakhs. Should I put 10 lakhs today in the stock market? No. Divide the 10 lakhs into 50 portions of 20,000 each. Send them every month. The remaining keep in a debt fund. Have a SWP from the debt fund, systematic withdrawal plan. Get it into your bank account and buy one stock a month. Now 3 years pass doing this. Suddenly there's a margin of safety. yes, now you can have a lump sum investment. Or you can have at least half the remaining money into the lump sum investment. If at all we are fortunate enough, I'm deliberately using the words, if at all we are fortunate enough to have another 50% fall from peak, then don't ask questions. Dump every available rupee in the stock market. What we don't realize is, at that level, the stock market is not risky. So this is the most important tool that Benjamin Graham could ever give us. And it has been implemented by all the leading investors. Warren Buffett. Whether we are talking about socks or stocks, I like buying quality merchandise when it is marked down. See how he believes in the margin of safety. I want it to come down, I will buy. Let it be anything. And Jason Zweig, the intelligent investor, realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall.